Hi, my name's Barrett Young, and today I want to talk about the tax implications of adding your kids to your house. A lot of taxpayers might do this because they think that it's going to simplify the transfer of their asset, their largest asset, upon their death, and that they can avoid probate court, and that is simply not true. It's got a lot of tax implications. I'm going to go over some of the situations that I've seen in almost 20 years of tax preparation as a CPA so that you can avoid these same errors and not send thousands of dollars to the government without needing to. Okay, for these examples, we've got our taxpayers here, Corey and Topanga. Corey and Topanga bought their house in 1992 for $200,000 and is currently worth $580,000. Corey and Topanga have two kids, Riley and August, and they want to plan for the future by moving the house into the names of their children. All right, in our first scenario, they bought the house $200,000 and it's worth $580,000. Corey and Topanga sell their house. This is a standard event for a lot of taxpayers, and it's very easy to do. So your house is sold for $580,000. Your basis in the house, what you paid for the house, is $200,000. Then you also have $50,000 worth of selling expenses, resulting in $330,000 of long-term capital gains. So your long-term capital gains is calculated by your proceeds minus your basis and any selling expenses. $330,000 of long-term capital gains. However, the federal tax code allows for a $500,000 exclusion of taxable gain from the sale of your primary residence. There are some limits on how this applies, but in general, if you've lived in that house as your primary residence, you're going to be able to exclude any gain from the sale of that house up to $500,000. So Corey and Topanga sell their house. The gain is $330,000. They take the exclusion, and it results in zero taxable gain. This, again, is a typical situation when someone has lived in their house for a long time, it's appreciated in value, and they sell the house. Situation B, same situation as before, $580,000 house. Corey died in 2010, and then now Topanga's going to sell the house. So what happens here, and this is what I advise my clients, anytime that a spouse passed, what you need to do is you need to have an appraisal done on any property that is owned. Not just your primary residence, you would also need to get an appraisal done on any rental properties that you have. The tax code has what's called a step up in basis that you are allowed to take when someone passes. So Corey's half of the house was half of $200,000. Topanga's half was half of $200,000. However, when Corey died in 2010, the house was worth $410,000 at that time, according to the appraisal. And so now Corey's basis is $205,000. His half of the house now will step up to half the basis of the value of the house. So Corey's basis is now $205,000 that he is passing to Topanga, as she is now 100% owner in that house. Now, Topanga could have sold the house in 2010 when Corey passed and been able to still claim the $500,000 full exclusion for primary residence, but because she did not, she instead got the benefit of Corey's half of the value of that house in 2010. So Topanga's basis in the house is now $305,000. And so when she sells the house, she's going to sell it for $580,000. She's going to reduce it by the basis, $305,000. She's going to again reduce it by the selling price, the selling expenses of selling that house, bringing her gain to $225,000. Her exclusion is now only $250,000 because Topanga is now selling this house as a single taxpayer. But because of the step up in basis, it's still going to result in zero taxable gain when she sells the house in 2024. The third situation that we've got, Corey died in 2010, and now Topanga dies in 2024. So each time the owner of the house dies, there is going to be a step up in basis. And so again, just like in the previous example, in 2010, when Corey died, his half of the house got a step up in basis to $205,000. and Topanga's basis remained at half of the original purchase price of the house. However, when Topanga dies in 2024, Topanga is 100% owner of that house. We're still separating out Corey's basis versus Topanga's basis, but effectively she's 100% owner in that house. And so the entire house is going to get a step up in basis to the value of that house as of the date of her death. So the basis of all of the gain in that house just disappeared because of the step up in basis. So by owning your house and continuing to own your house through your death, you are shielding all of that gain from your heirs. This is the mistake that costs thousands of dollars when I see this come across my desk. And I'm going to get into the why in some of the next examples. But because Topanga waited to pass the house to heirs until after she died, she gets an automatic step up in basis to the value of the house as of her date of death. That $200,000 house just became a basis of $580,000. So if the kids now decide they don't want mom's house anymore and they try to sell it, that basis in that house is going to be about $580,000, which is what it was valued at when she died. And they might get $590 for it, minus some expenses. And so they're actually going to have a loss on the sale of that house, which gets excluded. They do not have to pay any taxes on the sale of that house because it stayed in Topanga's name until she died. All right, situation D. This is what I see way too frequently. Corey died in 2010, and Topanga gives the house outright to her 2 children. In federal tax code, when Topanga gives the house to her kids, they get her basis. They don't get a step up in basis. Her basis becomes their basis. Because Corey died in 2010, his basis of $205,000 goes half to Riley, half to Augie, and her basis of $100,000 goes half to Riley and half to Augie. And so their combined basis in the house that mom gave them is $305,000. They sell the house for $580,000. Their basis is $305,000, selling expenses of $50,000. They have long-term capital gains in that house of $225,000. What they do not have is they do not have a primary residence exclusion. They did not live in this house before they sold it. They need to live there for at least 2 of the past 5 years in order to exclude the gain from that house. And so because Topanga gave it to them and they turned around and sold it, there's no exclusion on the gain of that house. It's $225,000 taxable long-term gain. Long-term is anything held over a year. So they do get her ownership period in the house. So it's long-term capital gains, which are taxed at 15% for federal for most tax rates. And then you add an additional 8% or so for state. This little mistake here cost $52,000 in federal and state taxes. Corey died in 2010. Topanga gives the house in 2024 to her 2 kids, possibly before she goes into a nursing home or just wants to give it to them outright to simplify her life. $52,000 mistake made. All right, it gets worse. The next situation that I've seen, Corey died in 2010. Topanga doesn't give the house to her kids outright. Topanga adds the kids to the house. So now Corey's $205,000 of basis that we had from the step up in basis now gets split 3 ways. So it's now $68,000 of basis to Topanga, $68,000 of basis to Riley, $68,000 to Augie. Topanga's basis in the house, $100,000, gets split 3 ways because she's given them 1/3 of the house each. Her basis is given to them 1/3 each. And so we still have a combined basis of $305,000, but now you can see the house is owned by 3 people. 3 people have to sign in order for it to transfer. And we get to the bottom here, we've got $225,000 of long-term capital gains. If they decide to still turn around and sell the house, mom is going to get the exclusion for $250,000 of capital gains because she's been living in that house. Her portion is taxable. However, Riley and Augie did not live in that house as a primary residence leading up to the sale of that house. And so Riley's portion is going to be $75,000 of long-term capital gains. Augie's portion, $75,000 of long-term capital gains. Roughly $17,000 federal taxes plus state taxes. So again, $35,000 to $40,000 in taxes by adding the kids to the house that you then turn around and sell. The next situation, and this one is heartbreaking, a case where she adds the kids to the house and then ends up dying that same year. So had she waited, obviously we don't know when our time is up, but this decision to add the kids to the house and then pass that year results in $164,000 of long-term gain, 82 to Riley, 82 to Augie, costing them, again, about $45,000 in taxes. Topanga's basis, she gets to step up in basis to 1/3 of the value of the house. Riley's remains the third from her mother and the third from her father's portion passed to her the third from her father and the third from her mother's portion. Augie's is the third from his mother, the third from his father, the third from his mother's portion. Their combined basis is $366,000. And then the sale expenses results in $164,000 long-term capital gains, 82 each, taxed at 15%. It's about $12,500 plus state tax results in about $38,000 in taxes in this situation. This is the ideal for estate planning with your large assets. Your spouse predeceases you and you pass, and your asset goes to your heirs at the value, the stepped-up basis, as of your date of death. Augie and Riley still inherit a house worth $580,000, but they get it at the value at the date of Topanga's death, rather than what they paid for it or any combination of what they paid for it in 1992 or the valuation from 2010. The basis in that house is now worth what it is worth today. And then if they continue to hold on to that house for another 10 years themselves, that house goes up to $700,000. They're going to have still a basis in that house of $580,000, the value of mom's death. And so they're going to pay long-term capital gains based off of that basis, $120,000 of additional appreciation since they became the 50-50 owners in that house. But this is a much better situation to be in than to turn around 10 years from now, sell that house for $700,000 and have to go back to your parents' records to find out, what did they buy the house for in 1992? Did mom get an appraisal when dad died in 2010? And try to reconstruct the basis when you turn around and sell that house for $700,000. Can't find an appraisal, $200,000 of basis, $500,000 of long-term capital gains. This is a big deal, and I see it way too frequently, and so I wanted to make this video so that you can make better informed decisions. So as you can see from these situations, it's a very complex matter. It's not as easy as just adding your kids to the deed, and it can cost you thousands of dollars. What you really need is you need to talk to an estate attorney who can draft up a will and make sure that the house still passes to your heirs as you intend, but does so without the tax implications that we've just gone over. Thanks for watching the video. Go ahead and like and subscribe to the channel, and I'll see you on the next one.